Americans have racked up more credit card debt than at any time in history, according to Bank of America, surpassing the total amassed in 2008 during the global financial crisis. And we're taking on all this debt at a time when the average interest rate on credit cards is on pace to hit the highest level on record. I'm going to tell you just how much more debt households are carrying, why this is happening, and explain why this could be a serious problem for the economy. Let's get into it. Bank of America estimates that the average US household was carrying more than $8,500 in credit card debt as of July. That surpassed the previous record high set in May 2008 and is more than $1,100 higher than the 10-year average. The Federal Reserve found that in the second quarter, credit card balances saw their largest year-over-year percentage increase in more than 20 years. Unpaid balances on credit cards have grown by over $33 billion a month over the past 6 months. That's more than double the pace from 2019. These are all huge numbers, and economists say the biggest reason for the surge is stubbornly high inflation. I talked to Aditya Bave, Bank of America's senior US and global economist. He told me that rising prices have been a double-edged sword. Consumers are spending more because things cost more. And while higher wages and job creation help offset some of the pain from higher prices, they also help create more inflation. Bave adds that B of A's data show that consumers are actually in a pretty strong place, and they aren't experiencing liquidity problems, meaning they aren't using credit cards because they don't have the money. They're using credit cards largely because they're buying a lot more stuff. But we're starting to reach a point where this could become a problem as spending continues to rise, but Americans' balance sheets are starting to shrink. We've seen the savings rate fall significantly in recent months, from almost double the 10-year average as recently as April 2021 to about half the 10-year average in August. That could become a big problem if millions of people lose their jobs. And that's what the Fed is predicting. Bank of America foresees a US recession next year, as do other financial institutions like Jefferies. And organizations like the IMF and World Bank are warning of a global recession. Americans could then be facing record high credit card balances with record high interest rates, right as the economy is slowing down and starts contracting. We're also seeing credit card debt spread to younger and less qualified borrowers. Credit reporting agency TransUnion found that in the second quarter, the number of bank-issued credit cards topped 500 million for the first time ever, with a 32% increase in originations for Gen Z. And the segment of total balances held by subprime borrowers rose by 52%, the highest growth rate ever. Right now, US employment is rising, savings balances are high, and Americans look to be in pretty good shape. But data on business activity and the housing market suggests that could be changing. The huge jump in debt and the rising cost of paying for that debt are definitely worth watching. Young Hove, aka Jay-Z, had the right idea when he told us in 2006, "I don't buy out the bar, I bought the night spot. I got the right stock. I got stockbrokers moving it like white tops." That's all for now. See you next time.